how exactly does angel investing work? Right? You write a couple small checks into the next Facebook, Uber, Airbnb, and you're off to the races making billions of dollars? Well, unfortunately, it's not that simple. And that's why today I'm sitting down with Hall Martin, a prolific angel investor and the founder of 10 Capital Network, who dives deep into the basics of angel investing. Hall shares the common pitfalls that most new investors make and how you can increase your chances of hitting home runs right out of the gate as a first-time angel investor. We'll also talk about the different ways that you can invest direct into companies or using things like equity crowdfunding. And this was really a fantastic episode. And the impetus for this was really wanting to have better conversations. I've got a number of friends and folks in my network that have been in tech and are now at the point where they'd actually like to start investing in companies themselves. And it's not really obvious where to start or how do you make really good decisions. And so this episode is for you guys, and I hope that you enjoy. So without further ado, here's today's episode of the Silicon Alley Podcast featuring the Hall Martin. Are you interested in growing and scaling your business? Welcome to the Silicon Alley Podcast, where you'll hear from entrepreneurs, venture capitalists, and top performers on what it truly takes to grow and scale a business. You'll walk away with actionable insights you can apply in your own business and life. Now to William Glass, the CEO and co-founder of Ostrich, and your host of the Silicon Alley Podcast. Paul, welcome to the Silicon Alley Podcast. Super excited to have you on today.
Great. Looking forward to it. Glad to be here. Thanks for having me, William.
Yeah, absolutely. Absolutely. And we were just talking before we hopped on about South by Southwest, which is just kind of wrapping up. And sounds like the vibe is where it wants to be for the startup ecosystem again, which is nice to hear.
Yes, it's back in full swing. Everybody's back at it. It's a lot of fun. Weather's nice. So we see a lot of activity going on with it. It's coming back for sure.
Awesome. Well, I'm excited to dive in today, and we'll cover startup investing, both from the startup side as well as for angels or people that want to get involved as investors themselves. There's obviously a lot of new avenues to do that, from direct investments, crowdfunding, angel networks. So there's a lot of things that we can talk about. But I'd actually like to start and just get some context. How did you end up in the investing space and in the startup world?
Sure. So I worked for a company for about 24 years after I graduated from graduate school. And, they went public in 1995. And I started doing angel investing after that because I wanted to, work our way into it. I'd started, with investing in individual mutual funds and then index stocks and sector stocks. And as you go up that curve, you eventually come to angel investing, where you're investing in private companies rather than public. And we had a network here in Austin called the Capital Network that ran from 95 to 2002. And I joined and went to the meetings and invested in one of the deals and lost all my money. And so I quickly learned it's not as easy as it looks. It's true of most things in the investing world. And they went away after 2002, and we didn't have a group. And then in 2006, the city did a restart, and they called it the Central Texas Angel Network. And I was the first member to sign up. And when you're the first member to sign up in an angel network, you're automatically on the board in charge of membership. It's a great honor. No pay, but it's a great honor. And so I did that for 6 months, and then we lost our director. So I became the director and led it for the first 2 years. And we ended up getting a 40x return out of it, and really got excited about that because this is a great path. One of the best things about startup investing is that the upside is truly unlimited. Real estate, oil and gas, stocks, just about everything else has a very limited upside, much more known, but the startup world is truly infinite. And so I got excited about that. And after a few years of working with the angel networks, I ended up starting 3 of them in Texas. Central Texas Angel Network, one at my university, Baylor Angel Network. That's a great place to do it. And then a county that wanted to attract companies into the area, providing local support. And so I decided to retire from my day job, and then started this company under the name Texas Entrepreneurs Network, and started working with companies and startup investors, mostly angels, about how to invest in startups, and startups, how do you raise money from angel investors, and trying to put the two together, because I saw a lot of people just not educated or still learning about it. And you'll find that on both sides. Startups are just learning about how to run a business, and early stage investors are learning how to invest in startups. And so that's where we focus, and I've just been doing it over the years. And we, kept growing our program and our network. And in 2017, we changed the name to 10 Capital. That's what 10 stands for. And now we work around the country. And our mantra is we connect startups and investors for funding.
That's awesome. Yeah, thank you, Hall, for that background, and can definitely agree that through the conversations that we've had with angels that have invested in my company Ostrich, we've done a lot more educating because for a lot of them it's been their first investment, and so that's been interesting. Of like what are and obviously we've just learned this stuff as well. So it's you know we're teaching the blind leading the blind in some respects, which has been interesting. So I definitely want to dive into that. But I'm just curious, how did you lose all your money and still want to keep investing in startups like that? We skipped right over that as if that's just a natural progression.
Well, it wasn't a huge amount of money, and like I say, I was learning, and I was just trying to figure things out, and at heart was trying to get experience from it more than anything. I wasn't going to get hugely rich off that 25K investment anyway, but the idea that it just all went away is something you have to take into account whenever you write a check as an investor. You have to kiss that check and say goodbye, and you really mean that you may never see it again. And if it comes back, that's great. If it doesn't, well, you've already said your goodbyes. So you have to go into it with the mentality that you can lose all your money, and in some cases you will lose all your money. So it's just part of the game. But like I say, the upside is limited. And from that, I learned many things about how to diligence a deal, how to work with them, how to decide what to go after. And I once told that story to a group of investors, and I ended it with, I must have made 25 mistakes. And the guy in the back said, no, you made 50 mistakes. And so, so there's much more to learn than you think there is to learn. So that segment of what I know, what I don't know, and what I don't know, that last segment's pretty big in this space for sure.
Awesome. Well, yeah, let's dive into that. And I think it'd be great just in case people have heard the term angel investing, angel networks. Can we just quickly define that to make sure that everyone's on the same page that is listening to this?
Sure. So an angel investor is an individual that's investing their own money, and they meet the SEC, Security Exchange Commission's requirements for being an accredited investor. No one typically checks, but you must have a net worth of $1 million or more, or not counting the house you live in, or 200K if you're single, 300K of income for 2 years in a row. And they continue to expand that role. If you take a Series 69 compliance license and pass, you are accredited. If you run a family office fund, you are accredited. And so there's many more ways to become accredited, but fundamentally it's those first two that people did. And they set those rules for the most part back in 1969. And since then, they only changed it once, and that was back during the Bernie Madoff day, where they said you can't count the house you live in to see if you're accredited. Well, today continue to expand the number of people who can be angel investors. But I will say that of all the accredited investors, only about 3% join formal angel networks. The rest either invest individually or on their own or in some other way.
Awesome. Yeah, thanks for defining that. And definitely want to talk about like crowdfunding and how that's approachable and another option both for accredited and non-accredited investors. So now we've got a definition of what an angel investor is. So what are the networks specifically? Like how does an angel network typically work, and what is their role versus, saying that there are only about 3% of accredited investors that are actually in these networks? What are their role versus, doing this on your own?
So what they're doing is gathering investors together to share the deal flow and the due diligence. If you ever done angel investing, you'll spend all day talking to potential startups, and then you'll spend all night doing diligence on them, and it can quickly wear you out. And so people gathered together, accredited investors, into angel networks starting back in the late 80s and then the 90s, and then here we are in 2022 with them still rolling. And it's a great way to band together to share the deal flow. Typically there's a membership fee that you pay to join the group for a year, and some have requirements for you must lead a deal or you must invest or what have you. Many don't have requirements as well. And what you can do is learn from others in those groups, get the benefit of the wisdom of other people, because quite often you'll see deals that come in a variety of places: technology, consumer product, healthcare, life science. And while you may know some of those, it's rare that you know all of those. And so you're leaning on the expertise of others to say, yep, that's a good deal, or no, that's not. That's a winning model, or no, that's not. And so that's why people come together for angel networks, is to share that workload, so to speak.
Awesome. Yeah, that makes a lot of sense, Holland. I mean, you've just listed in the short time that we've already been talking all of these different things that you have to think about as an angel investor, and the only requirement is that you have to have either a certain amount of money, or you have to have domain expertise through through either licensing whatever series, I think series, would you say series 69? I think there's a couple others, right, that also allow you to get access. So you've got to have some either domain expertise, but that doesn't mean that you know how to do this. So if you're interested in investing in startups, where do you start? Like where do I start?
So you start with an investment thesis. What do you want to invest in? What do you think is going to be successful? In the venture capital world, they actually write this out. In the angel world, they think about it a lot, but you rarely see it written out. But the idea is, what do you think is going to be a successful investment area? For example, I think healthcare is moving to the home. Okay, well, let's look at deals that are enabling healthcare to enact it in the home. And then you start looking at what deals can I find that are in that space, and is that space still a competitive space? Is it locked up by a big player, or is there still a lot of disruption that's going on in that space that we can be a part of? So you're looking for disruption that will lead to high growth. And so you're looking for the growth segments that are out there. And then so at heart, you're looking for deals that you are interested in investing in. You'll find many good deals, but if you're really not that passionate or interested about them, it's not probably a good idea to invest. In the end, it takes a fair amount of time, both in dollars and in work, to help that company become successful. So you want to work with the ones you think are going to be successful and the ones you want to work with as well. And so that's what you do, is figure out your investment thesis, apply, allocate a certain amount of funds to it, a certain amount of time to it up front before you go in. How many hours will I spend on this? How many dollars will I spend on this? Oftentimes you take the amount you want to invest and you do half up front, and then you do half 18 months later when they're getting good traction but need more funding. You can help a little bit along the way. As angel investors, typically that's about as far as it goes. Venture capital, they can do multiple rounds and so forth. And so the question I always ask when I look at a deal after I figure out, yeah, I like it, is how can I help them? What can I do? What can I bring to the table? Is there coaching? Is there business expertise? Technical expertise? Can I bring other investors to the table? What can I do to help? And I find that's always a better indication. There's a saying in the angel world: angels want to do a little good, have a little fun, and make a little money. And so, obviously you want to return, but to do a little good, you really want to be able to give back to the company in some way. If you can't, it just seems a little bit lacking. And then you want to have a little fun. And that usually comes down to the team. Do I want to work with this team? Is this team great to work with, or is it not? And if it's not, don't walk away, run away. And so the idea is make sure that you cover all three of those bases.
Yeah, no, I like that. I like that whole, yeah. Do a little good, make a little money, have a little fun. I haven't heard that before. So this makes sense. All right, so you've got a thesis in the space. You know how much time and money you're going to allocate. Just start talking and messaging startups, join a network. Like, how do I actually find deals? Where do those deals come from?
Sure. So there's a lot of deals out there. You can't turn around on LinkedIn, Facebook, Twitter, and not see deals come at you. And you'll see over 100 deals in a month easily. And get in the crowdfunding world, you'll see 200 deals a month. So there's plenty of deals out there. I think that the thing you have to do is look for quality deals. Where are the deals where they have a real business, a real team, a real product, real revenue? These are the things you start to look for, because there's just too many deals that are ideas. We got a lot. We saw a lot in the 2017-18 era of the ICO white paper craze that was blockchain, and so we saw a lot of almost none of them had revenue. So it was just really hard to work with. When the business has revenue and they have a team, that there's something there, you'll find it a lot easier to diligence. There's something going on. Maybe you want to throw 5K at it just to see how it plays out, and a lot of angels do that. But the idea is you want to put good money down on deals that you think really have a chance of winning. That's only after you've done your diligence. And then that's one reason why people join angel groups, is that they can share the deal flow, and you can, as a group, set up deal flow channels with other networks, VC funds, syndicate groups, other angel groups that have funded deals. Send them our way. We'll look at them as well. It's very rare that a group puts all the money in that a startup needs. They usually put in a 10, 20, 30, 40%, something like that. And then they pass you on to the next group to see if they want to invest. So syndication is the big issue, and setting up relationships where there's quality deal flow is what you're looking for, and knowing what you want to invest in. If I want to invest in medical devices, that's going to be a different group of people than if I want to go invest in blockchain.
Yeah, no, that makes a lot of sense, Hall. So yeah, connecting with the right groups of people, the right sectors, what you're interested in investing in, and then building those networks so that you can get that deal flow. So you mentioned some things that are quality metrics, right? So revenue, real product, team. Are there other indicators, or is there a certain amount of revenue that you should look for? Does this differ based on the sector that they're in? Can you
So
talk a little bit
typically
about
you're
that?
looking for, a growth segment. There's some disruption or something going on that makes this a standout. It's just not any place. It's a place where we expect there's going to be growth in the market. So the rising tide lifts all boats. Will lift this one as well. And then you're looking for other issues, regulatory. Are we trying to do something that goes against the regulations? Healthcare, fintech are highly regulated industries. And if you're coming up against regulations, that could be a challenge. If you're getting into the life science, you look at the clinical trial progress. They typically won't have revenue, but they're on the FDA path to 510K or some other indication. And so what you're doing is trying to figure out where on the path are we, and do they know what the path is many people don't quite know exactly how they're going to get there, and that can be a tough one to invest in as well. I think you're looking for something that has maybe a little bit of a moat or competitive advantage. I define a competitive advantage as you have a 30% increase in revenue over the competition, or a 30% decrease in cost over the competition with what you have. And so I always look for that. What are we doing that other people can't or cannot do as easily, and see if there's a numerical number there to show that.
That's really interesting, Hall. I haven't heard, I mean, you hear people say find a competitive advantage and a moat, but I've never heard anyone actually put a number or a way to actually start to think about how do you measure whether you have a moat or not. Besides, people will say patents, but realistically, especially in software space, you can get around patents in a number of ways.
Right. Yeah, that is right. Whenever you ask a startup, what's your competitive advantage, basically they'll talk for 5 minutes, and what they said is, well, I just think I'm better. Okay. There's no evidence of that. And how do I know this is really going to work? And now if they have some technology or something, well, that's great. But the next step is, are we seeing that come through on the business model? How are you actually able to win business over the others? And let's see that. Let's see how that's working. And that really stands them apart. You start looking for those companies, that slims down the deal flow pipe to a much smaller number.
Yeah, that makes a lot of sense, Hall. Now, we skipped over something. You said, set aside a certain amount of money, but what does that mean, right? Like you mentioned earlier that your first investment was 25K. You've also mentioned throw 5K. Like, if you're going to actually start investing as an angel investor, most of the deals probably aren't going to work out. So like, what is the right amount to start with? And what does the check size need to look like to have a relatively, balanced, in quotes, portfolio?
Sure. So typically in angel and venture capital investing, you're investing 3 to 5% of your disposable income. How much you have to invest this year, you can put 3 to 5% into it. If you're going to be a full-time angel investor and take a real professional approach, I see people go up to 10%, but I really don't see people going past that. And so that gives you a certain amount of money. And then what you want to do is you want to get at least 10 funded deals out of that amount. So people used to walk in with $1 million, and they're going to put, $100,000 on each deal. So I have for each deal, 250K checks, 150K check for the initial investment and one for the follow-on investment. And so I've got this many checks, and now I'm starting to look at how I'm going to allocate those funds. Today, I see a lot of people coming in with $100,000, and I've got 10K checks I'm going to be putting into each of these deals. And so that's where crowdfunding comes in. I can just go on the crowdfunding portal and start popping 5 and 10K into these things. And of course, the average investment on crowdfunding today is around $500. So you're something of a whale. If you put in 10K, you really stand out in that crowd for sure. But the idea is you want to get diversification across 10 deals. One will be a home run, one will go under, 2 or 3 will do well, and then 4 or 5 will do maybe 1 to 1.5x return. Something comes back, but not a lot, and it may take a while as well. So diversification is the key thing you're trying to look for. So depending upon how much money you want to put in, that's what you do. If you just put a 25K check here or there, like I was doing, you will most certainly lose, because the odds are just greatly against you. 1 out of 10 to find that winner is really hard.
That makes sense. That makes sense, Hall. Now, you mentioned diversification, but what does that mean in the context? Because you also said, let's focus on things that you're interested in. So if I'm only interested in fintech or healthcare or, CPG, like, how do I get like what does diversification actually look like? Is it just 10 different companies, or B2B, B to direct to consumer? Like, there's so many different ways that you could slice this. What does diversification look like?
Even in the fintech sectors, there's 6 types of payments out there, and there's many other areas. There's banks, there's blockchain, there's AI. There's a lot of different things that go into the financial sector. It's a very large space. So it's not hard to go find 10 different subsectors inside the financial space and start putting money down on those different ones. And if you were doing therapeutics, for example, that can be a little bit of a tough thing because there's such a long play on those things as well. But if I did cancer therapies all day long, that's a bit of a risk there because those have such a long lead time to get to an exit as well. But usually within these sectors, you can find a range of different investment thesis and different approaches to it, different parts of the market that are going to grow, and you can hit on some winners doing that.
Awesome. Yeah, that makes a lot of sense. And just zooming in and thinking about the different ways within an industry, right? So as you said, in fintech, there's a lot of different subsectors, and feels like there's new ones that are popping up every day, especially with Web3 and blockchain.
That's right. It's very diverse. Yeah.
Exactly. So, Hall, you brought up crowdfunding, and we briefly touched on it, but how does crowdfunding differ from angel investing?
Well, so crowdfunding is all online. It's posted on a portal, and you basically are, as a startup, you're trying to get your network to go online and invest in it. And then if you're on a portal, you're having them invest. And then after that, you're trying to go to other groups to invest as well. And what you'll find in the accredited investor world with angels, you're spending your time going around because you have to go through these screening and presentation and diligence processes for them because they're writing 50, some 50K checks each, and 250, 300, 500 in some cases are coming out. So that's real money. And so there's real diligence on it. And so in the angel world, you're spending your time going around. In the crowdfunding world, the average investment is $500, maybe $750 for some. And what you're doing is you're going around and you're using social media and email spends to drive traffic to your page. And so you're not spending as much time, but you're now spending dollars on the marketing. You can spend easily 10% of the fundraise on the marketing itself to raise it. The first $1 million is pretty easy, but from $1 million to $5 is can be an expensive slog to go through because you've gone through your network 3 times, you've gone through the platform's network, and you've gone through everybody and now you're going out to other groups and trying to get access to their network to drive to your page. You can only have so many updates. You can only do so many things before you just really have to just start paying for marketing to drive traffic to it. So that's the biggest difference, is how you approach it or where you're going to spend to make the fundraise work.
Yeah, no, that makes a lot of sense, Hall. And that was something that we were surprised that we looked at at equity crowdfunding and realized how much money you've got to spend on marketing to have a lot of success. And you don't think about that, and it's kind of almost counterintuitive to say, well, I almost need to raise a little bit of money to make sure that I can go raise more money off of the platform. But to your point, it's a different process that doesn't take as much time necessarily, but is more capital intensive.
That's right.
Okay, so we talked a little bit about that. Well, what about from the investor side? So you mentioned, how does that materially differ when you're looking at a crowdfunding deal versus, a direct investment as an angel? Like, because you're probably not talking to the team necessarily. You're not, hopefully they've already done the diligence for you, right? That's part of the process to get approved for the crowdfunding platform. Like, how does that differ? What's the different mindset as to why I should go the crowdfunding route or the direct investment, or maybe there's a hybrid approach?
Well, with crowdfunding, it is regulated. It's called Reg CF for crowdfunding, and there's a form you have to fill out called Form C. And the portal is basically achieving compliance. But what you'll find, even with brokers in the accredited investor world, is achieving compliance and doing due diligence are really 2 separate things. Compliance means they've checkmarked that box. It doesn't mean that that's a good working business model, for example. And so you still have to do diligence on it. I think the difference is when it's 50K, you probably put some serious effort into really understanding the business and getting the documents. And in crowdfunding, when you're putting in $500, you're probably putting a lot less diligence because it's just $500. But there is a certain amount of information that is given to you, financials, and go look at the website, and you can contact the team, and usually through email, but you can get questions answered directly by the team as well. So there's usually some diligence that goes with it. The key with all these startup investments, I tell primarily angels, is when you are seriously thinking about writing a check, most people spend their time on the product or the space or the competition. I say, yeah, that's nice to go look at that, but go meet the team. If you can, go drive out to the team's office. And when we had angel groups and did it locally, that was not too hard. And go in and meet everybody on the team and find out who is doing what and what do they really know and what is their really their capabilities, and then see if that's enough to achieve the goal that they have set on the plan. And you'll find that in the end, all failures go back to one thing: the team wasn't up to the task. We may have underestimated the task, but in the end, the team has to be up to this. And so you're looking for a rock star team that can really do this and take it going forward. So that's the key thing is the team is what makes or breaks it. Even on crowdfunding, you can check out the team a little bit to see, are these the right people? Are they doing the right thing? And do we think that's going to be successful?
Yeah, that makes a lot of sense, Hall. And I guess you hear this a lot, right? Like it's the team, the team, the team. But like, what does that look like? Is it, because it's not necessarily just they went to Stanford and they have, worked at Google. Like what actually makes a good team?
Sure. So your first question is, do they have domain knowledge? We see a lot of people coming from one industry, say fintech, and moving to another, healthcare. Well, those are two very different industries, and not to have, you have 25 years of experience in fintech. Okay. Everybody and what goes on in that industry makes a big difference. Knowing everybody really helps a lot when you start building channel partners and finding customers and getting in to the right places to sell your product. And if you have jumped to another sector where you don't know a soul, then you're going to be greatly limited. So that's one thing to think about. It's not just so much, do I know what's going on in fintech, but do I have enough contacts that I can get into my top 5 customers and help sell the product, is what we look for on that front. And then the other is, do we have the right skill sets here? We used to see people going into blockchain, but nobody knew anything about blockchain. And they were outsourcing it. And so you look very hard at the outsourcing function. There's a right way to do it and a wrong way to do it. The right way is you have a domain knowledge specific person that is just using them as outside coders, but they are driving the architecture and the specification and the quality control, and they own that. The wrong way to do it is just assume we don't need anybody and they're going to take care of it all for us, because that is a real roll of the dice that you'll do better at Red 7 in Vegas than you'll do at that, for sure. So anyway, those are some of the things to look at, is diving into what the team really knows, looking to see if they're full-time on this. It's amazing how many of these guys have 3 side gigs and a full-time W-2 job at the same time, and you wonder what time slice will we get for this. So you look at that aspect of it. Does the team get along? Have they ever worked together before? Do they all have the same vision? Do we all? And I get a fair number of starters coming to me saying, half my team wants to step on the gas and go to the moon, and the other half want to just grow organically, and every meeting's a fight. So having the same vision across the board makes a big difference as well, to make a successful team out of it. So those are some of the things you look for to see if this is really on the right track. And what is the exit? What's the vision here? How are we going to grow this up and sell it, and who's going to buy it, and what do those guys care about? So those are things to start asking sooner rather than later.
Yeah, absolutely. That makes sense. Yeah, wanting to know exit, have the team work together, what's their domain expertise, all really, really important. And it's funny that you brought up do they just outsource? I think that's one of the things as a non-technical founder building a tech product, that's something that we worried about, is like, I don't know that I want to go hire someone, or that I'm qualified to really go hire someone to go build this, because I can do as much research as possible, but in terms of architecting it and directing, you really aren't able to do that. And so how do you bring in someone that can, and having it in-house allows you at least to have that ability where you've got someone that's a part of the team versus being outsourced contractor that, paid per hour or project or whatever. And that can seen that spiral out of control for a lot of people.
That's right. It's a big thing for sure. A startup team at the very early stage is a complete team, I should say, is someone building it, somebody selling it. No fair, we're all building it and nobody is selling it. I have seen teams where they were all selling it and nobody building it. Came back 6 months later, and instead of having a nice software package, they had a spreadsheet that would not fit on the side of your house. They just put everything into an Excel spreadsheet, and it, of course, breaks down when you get to that type of process. So you do need to have someone that can build tech and on your team that can drive that function.
Absolutely. That makes sense. That makes a lot of sense. Now, I do want to play a little bit of devil's advocate here on the team thing, and really just to kind of clarify this. So, two things. One, if you look at like some of the really big success, Airbnb, their team didn't have hotel experience or hospitality experience early on. You look at Facebook, Mark Zuckerberg was not a social guru, before what they ended up doing. There are some examples, right, where there are outliers. So that's one piece of it. But then also in having conversations from a startup perspective, there's a lot of times where you don't move forward, right? And part of it is never you're a bad team. It's always, hey, product's not far enough along. Hey, there's not enough revenue, or maybe we just don't see enough customer traction. And that's always the feedback that I've heard, as well as other founders that I talk to. It's never, hey, you're a crap team. Like, no one, I think, really says that. Maybe it's for social reasons. So I want to dig deeper and say, is there something that actually proves out the team that is that has more to do with traction execution than necessarily, I don't know. That's my kind of thought process there. And I kind of loaded you with two questions there, two thoughts.
Well, on the team, if they've done it before, we have people here in Austin that, their last three startups were, ended in 9-figure exits for everybody involved. So when they go out to raise funding, it's a probably 30 days and they got their $1 million, which is pretty fast. And because the team knows how to do this, and they're pretty much running the playbook again. So you're looking for people that have done this before. And now for first-time founders, they don't have that. And so now what you do is you look for, how are you putting together the MVPs and the early stage tests? And this is where most startups fail, is they don't even do an MVP. They just want money to go build the final product, and they're just sure it's going to work. Well, this is going to be tough. So what you're looking for is the team doing things to validate the business model. Have you run a test? I had a guy come to me once with a software tool that he basically took $5K of his own money, bought some Facebook ads, and came back with the metrics on it. This many people clicked on it, this many people opened, many people downloaded, this many people bought. And so my CAC LTV ratio was 8-to-1. And they actually showed conversion rates, and they actually tested it out. Now, I talk to startups every day about this, and I can tell you it's very, very few actually go out and do the testing. So that's one way to test a team is, well, let's go validate these different points you're saying. You think that's the right price? Prove that. You think this is the right packaging and business model? Let's go test that out and see how many people are engaging with that. And in the software world, that's not hard to do. You create an e-commerce page, you create a website with a landing page, and you just start driving traffic to it to see what kind of conversion rates you get and what story that looks like. Of course, along the way, you learn. And this is where crowdfunding came in. A lot of people ran their deals on Kickstarter to actually see what the right price, product, position, promotion was going to be very effective. Some people just used it to do that and didn't even take the money at the end of the day, because now they know what the real product's going to be. Let's just go build that, because they got the lessons learned. So you're looking for people doing those things in the early stage to really test it out, to really understand it. And those who do usually come back with a good, solid start on their business. Doesn't guarantee it's going to go all the way, but it's something that you can look at. So that's one thing to look at. The team is, what are you working on and what are you learning about the business itself? Every day we should be learning something new. And the MVP is really, the MVP of the week. What are we testing this week? What are we testing next week? And you go back to the investor, if you're doing that, and say, this is the lessons we learned. And I'm a big fan of what I call unit economics. Even at the early stage, if you can figure out what cost of customer acquisition is and what lifetime value is on a unit economic level, and that's a profitable business, that's the story you take to investors. The challenge is most startups don't even get to the unit economics, but they're hoping somebody's going to give them money so they can take a full swing at the plate. So that's something to look at is how you actually validate the market and validate the product. And that's where, somebody will pay for it and the product will work.
Yeah, no, that makes a lot of sense, Paul. And I appreciate you clarifying the, repeat founder who's had 3 or 4 9-figure exits, which you can have a lot more confidence in, right? They get it, they know what to do, versus a first-time founder who has a bigger hurdle because you're learning, right? And part of the thing as an investor is you want to invest in businesses that have a higher chance of success, and you don't want to pay for someone to learn. So as much as you can do as a first-time founder to get as far along as possible, validate the business, and prove out that there's something here that's worth investing in.
Right. Absolutely.
Is the key. So makes a lot of sense. So we've covered a lot of ground here in terms of investing in startups. What are some of the most common mistakes that you see investors make, and then would love to also get startups as well when they're doing an angel round?
Sure. Like I say, most investors don't actually set aside an amount that they're going to invest. They don't have an investment thesis. They just look at each deal by itself to say if that's a good thing or not a thing. I think if you look harder at the world, you'll see that there are certain things that are going to be very successful in the next 5 years. And so if you focus on those areas and start looking for deal flow, you'll find the deals if you look, and you can get into higher growth segments. And that's the key, is you really have to be in a good growth segment to go forward. And then the other thing is valuation. And this is the big difference with crowdfunding and the accredited investor world. Angels are writing checks, and VCs have been written checks many years, and they know that the valuation is a very important factor. How much do I own after I write this check of the business? Because that tells me where I'm going. If you take a deal where the pre-money valuation is $10 million and they have $1 million of revenue, you can calculate out with a little bit of math to figure out if we think we're going to get to the exit and have a meaningful return at that point versus we don't. The challenge with the crowdfunding, and so the angels put market reality into those deals. They just don't write checks for the ones that have outsized valuations. You should see on LinkedIn people shopping their $1 billion valuation startup, and I thought that there's no way we'll ever get money out of that. Well, in the crowdfunding world, there's really no one there putting market reality, and so you get these very wild valuations. Sometimes I have 50K of revenue, but I'm worth $50 million of valuation. So, well, how did you get to that? Well, I just think I'm worth it. Someday I'll be very big. And one of the things about valuation is today's valuation is for today's fundraise. Tomorrow's valuation is for tomorrow's fundraise. No fair taking tomorrow's valuation for today's fundraise. When you see that a lot. And in the end, valuation is more of a negotiation than it is a formula. And that's the challenge with crowdfunding, is there's no one there negotiating with the startup founder. And so we end up with these very, very out of stratospheric valuations. And then when we leave the crowdfunding world and go into the credit investor world, it can be a challenge. VCs are trying to figure out, how did you get to $100 million on your valuation, but you got maybe 250K of revenue now. It's growing, but 100 million is way off the mark. And so those are some of the challenges that we see out there, is outsized valuations. And angels, I think, have learned to look hard at that. Crowdfunders will start to realize that valuation they put up there is a very big factor, because in the end, when they sell the business for whatever it is, you get that piece of it as your piece of it. The bigger that valuation, the smaller the piece you get, and so the smaller return you get back to cover your initial investment. So those are some of the things we see out there right now for startup founders, and actually with investors as well. There's different formulas for calculating valuation, and you want to do several of them to try to figure out what put your business in the best light. No matter what you put out there, the investor is going to push back and say, how did you arrive at that? And the key to negotiating a valuation is to articulate the values in the business. I calculated what I need to own after I go through this process, so I must be worth $50 million is not a convincing argument. You have to put out there, I have this team, this product, this technology, this IP, this revenue, and have those values there. And my coaching to startups is, don't don't show up to the investor empty-handed. I get so many people showing up. As one investor said, well, there's no team, there's no product, there's no intellectual property, there's no customer, there's no system, there's no product, but beyond that, it's looking pretty good. And so it's just one of those things where if you want to convince the investor, show up with something. Don't show up empty-handed, because it's going to be tough.
Absolutely. That makes a lot of sense. And I believe on the 10 Capital website, you guys have a number of calculators that are around investing, figuring out valuation and all sorts of, convertible note type, which we haven't talked about, but definitely I think makes sense to talk about as well. But a bunch of different calculators to help startups and investors figure out those numbers.
Sure. So, one rule I used was the rule of 4 for valuation. And so I put that in a calculator, and it says for every one of these 4 things, you get a $1 million valuation, the sales, the team, the product, and the intellectual property. So if each of those things, is fully built, fully in place, give yourself $1 million for each. Add them all up, you can get a $4 million valuation. If, on the other hand, you don't have all the patents filed, you have a few provisionals, well, let's give ourselves $250 for that. We don't have the whole team hired, but we have 2 out of 3. Well, let's give ourselves $650 for that. And so you can start to identify the values that are in the business. And I came up with it because I wanted to shift the discussion from the I just think I'm worth that to sit down and figure out what is really in the business today and put a number on it. And then now you have a meaningful discussion with the investor about what's there and then what's to come next. And so that's like I say, it's a negotiation, not a formula, but it's a way to start figuring out what is in the business and what you should be doing to put more into the business to raise more funding.
Absolutely. That makes a lot of sense and very helpful to think through, because you're right. Otherwise, it's just, well, how much do we want to exit with? And that's not a great way to figure out a valuation, especially, if you're a first-time founder as well as, first-time investor. Just really common mistakes to make because you're not really sure where to start. And so that just seems like something easy to calculate, but doesn't really, not a good way to actually value the business.
Absolutely. It's a thing that you really have to put a lot of thought into as well. Having put your own money into it helps a little bit as well. That shows you believe in the business. And then having family and friends put money in, I think, is also a positive. I do get people come to me saying, I didn't put any money in. My family didn't put any money in. Nobody bought anything. No one else invested. Hey, how about you? You want to invest? And so I'm going,
a lot of confidence building there. Yeah.
Right. And so I thought that's one of the values of crowdfunding is if you go on Kickstarter and I raise $50K, serve 200 customers, well, that's validation. People are buying your product. You go on to startup crowdfunding and equity crowdfunding, and you start to get equity investors coming in, and you start to prove that other people believe in this deal as well. Well, then when you go to angels, that all counts for validation because other people are in the deal. The last thing an investor wants to do is to be the only person in the deal. And the reason for that is that everything will then come back to them. They have to fix all problems. They have to do all work, and they just don't have the time for that. So you really have to be thinking about how do I validate this and how do I show support all around me? My customers like it, my family likes it, my network likes it, my team likes it. Everybody likes what we're doing here. Well, then this is something to consider as an investment.
Absolutely. That makes a lot of sense. So can we talk a little bit about convertible notes? Because there's also this idea of safes, convertible notes, and that happens a lot, especially at the early stages, so that you can kind of kick that can down the road in terms of having to value the business. What are where should you start? If you've never heard of these terms, how do these things function? And, should I invest on those or should I wait only for priced rounds?
Yeah. So that's a good question about convertible notes and safe notes. We use them quite extensively in the very early stage, pre-seed and seed level, because it can be very hard to figure out valuation at that stage. And I find it very hard to raise funding from investors if we are forcing them to climb the valuation wall. Well, then they have to figure out what the valuation's worth, and there's not a lot there to figure it on. And so we're all guessing, and the fundraise can stall out doing that. So my coaching is start with a convertible note on any round, seed, Series A, Series B. You start with a convertible note. A safe note is fine too, and put a valuation cap on it. For convertible notes, there's an interest rate discount rate, but the reality is those have a very, very small effect on the return. It's all in the valuation. And go out and just say, well, we're not setting the valuation now, but if you want to be in the deal, here's how you can be in the deal. And the valuation won't be above this other valuation cap number. And you start collecting interest in it, and you keep going until you find someone that comes in and says, well, I'm going to put in, 150K, but I need equity. Okay, well, for you, we'll have that discussion. And then you're basically looking for the lead investor, and the lead investor needs to put in a good chunk of money and wants to do the lead work. You got to go and diligence this thing and get it packaged up and get the right price on it. And that's what's going to stand up to the other investors. 25K check writer should not be diligencing a deal. It really should be someone putting in a substantial amount of more, because other investors are going to look at the quality of that work and the quality of that investor to say, yep, that's the right price. Let's join this round that we have here. So that's what we're trying to do, is not get into climbing the valuation wall just yet, but do it, 6, 9, 12 months later when there's more business there and it's a lot easier to raise funding on. The other thing we get in a lot with the startups is at the early stage, seed, pre-seed, and seed, is the watchword is minimum. We're doing minimum viable products, doing minimum viable tests, we're doing minimum viable networks, minimum viable customers, and we're looking at the minimum fundraise. I have so many people wanting to raise $5 million at the seed level, but let's carve out 250, 500, and let's raise that, because you're giving away a lot of equity at that very low valuation. Your valuation will go up over time, and so you want to reserve the majority of the raise for when your valuation is much higher, and you're trying to do as much as you can with as little funding as you're raising, because you're undergoing a lot of dilution with that funding. And so those are the things we look for in the early days. And convertible notes and safe notes, either one's fine for me, is a great way to get into the market and then go look for your lead investor who really wants to have the equity stake and will put the time into it as well. And I know some groups that go several years off just convertible notes, and that's fine too. It's a rolling close. You sign the company signs the check, you sign the note, the money goes into the business the next day. And so there's no escrows or all that going on. And then the other reason people use those is that they're foregoing the legal review. They're just getting a templated version and viewing that. If you get into equity, I'd say you really should have an attorney review it, because you're making a lot of decisions there that legal Zoom may not be watching out for. So you really want to think hard about the equity side. Convertible notes are pretty plain vanilla for the most part, and just having people come in at this stage usually isn't much of an issue.
Awesome. Yeah, that makes a lot of sense. And we've used Safe Note. It's been easy, simple. You got to explain it to people, but at that point, you don't have to have that valuation conversation. And again, try to throw darts at the wall and hope that you get it close to the right number. We've covered a lot of ground. I'm curious. You've been investing for a while. You run 10 Capital. You've got a ton of investments that you've done. You do a lot of work in different angel groups, teach about this stuff. Like, what does success look like for you? And like, what are you really hoping to accomplish in this space over the next, 5, 10, 20, 30, 40 years?
Well, I believe that innovation and entrepreneurship is what leads us out of problems. And so looking to help form capital for those early stage groups and helping investors find successful exits as well. If they don't get a successful exit, they're not going to continue participating. It's one and done. So hopefully trying to make them successful and trying to get capital put together for these early groups. Because I find that it's much more efficient than government funding. Yes, we need grants and so forth, but I think they have 2,000 grants for maybe 2 usable technologies is the last number I saw. So it's really not that efficient, but it does pay for a lot of basic research. But the idea is angels are usually funding deals that have a chance and the success, and that they're helping reach success with their efforts as well. So I find that's where a lot of the job growth comes from, and a lot of new startups, successful new startups come from is through that. So I believe in that in a big way. And so that's what we look for, is how much capital are we forming and how many startups are we launching and how many are turning into success.
That's awesome. I love that. And yeah, I completely agree. I think, there's a lot of things that connecting investors and startups and people that have ideas can really help change things and look at things from different angles. And when you have a bunch of people working on various problems, there's a lot of innovation that can come from that. Is there anything that you're in particular really, really excited about right now?
I think blockchain. I've looked at the technology of blockchain and seen it coming for several years now, and think that that really does solve a lot of problems and issues. We are on a 20-year development cycle. I remember in the dot-com era, people got all excited about what the internet could do and threw lots of money at it. And then in 20 years later, Mark Andreessen declared everything we tried to do during the dot-com can now be done 20 years later. And so you have to think hard about the amount of infrastructure that has to go into place to make those things successful. Seeing some early success there, but again, a lot of stuff really needs to be built out to make it worthwhile. And a lot of issues still need to be worked out, especially regulatory. So it's going to take some time, but I think the technology looks very, very compelling for sure.
Absolutely. Yeah, we're definitely excited about the potential for Web3 and blockchain and what that can enable. I think there's a lot of challenges personally from our perspective in the Ostrich perspective and the personal finance space that you can solve a lot of problems if you have better rails that kind of reduce some of the barriers that exist. So there's some cool stuff that I think on the horizon there.
Absolutely. Looking forward to it.
Yeah. So Hall, who are you looking? So you've got this mission to help startups and investors. So are you looking to connect with more folks? How can people connect with you? What is it that you're really, seeking right now in terms of from the audience? Any asks?
Sure. So anybody that needs help with raising funding, we have a monthly meetup. Come on in and ask any question you have about fundraising. We talk about deal structures, term sheets, valuations, milestoning, how to position it. Should you raise? Should you not raise? All those questions we help with. So anybody that's raising funding, we have what's called the 10 Fundraise Launch event on the 10 Capital site. It's at 10capital.group. And then investors, we have programs for you. If you want to learn how to invest, come on in. We do have premium programs where we'll take you through and help you figure out your investment thesis and your allocation and how to set up the system for what you might want to do for deal flow. And then we also have just access to quality investments that you may want to look at as well. So we again try to foster the entrepreneur ecosystems. We have syndicate networks around the country. We have a 10 syndicate too. So lots of ways to engage either individually or with a group. We can foster that. And we also help angel groups find members. That's one thing I've found in capital formation is I've helped a half dozen angel groups already find new members for their group. There's not many groups out there that do that. And we help, again, try to get more people connected to a group because they'll probably be more successful than if they go it alone. So if you're an angel group and need help with finding members, let us know. We have an extensive network and we're reaching out, showcasing that you're an option for them as well.
Awesome. And you've also got a podcast, I believe, right, as well, and some other content that people can consume if they want to start learning more.
Sure. So our website, investorconnect.org is our podcast site. I started it as a 501c3 as an education program. And when I ever talked to angel groups, what they always told me, I learned this from many people, is that they wish they had more institutional knowledge reserved, because what happens is people come in, they start doing angel investing, they make lots of mistakes in the first 1 or 2 years, start to get it right in years 3 or 4, they start to really hit their stride in years 6 and 7, and then they retire. Or they get distracted away with other things. And so here comes the next group, and they're following along the same cycle, learning, making all the same mistakes, learning all the same lessons over again. And so we've done over 650 interviews with startups and mostly investors, talking about what do you invest in, how do you invest in, what's your advice, what's your thesis, what do you look for? And you can learn a lot from that, because when I was an angel investor, I learned from a guy named Frank Peters. He had the Frank Peters Show. He was a Tech Coast Angel in Southern California that he had over 450 interviews. And I learned more from those interviews than I did from anything else, because it was people talking about how they did deal flow and diligence and so forth. And it was very educational, and podcast is a great medium for that. You just need to, just like listening in on a conversation is what it was. You don't need the video and all that. So that's why I started my podcast program, is I thought that's a great place to install institutional knowledge. And we have 20 plus e-guides up on the website and a half dozen calculators, and there's other resources out there, but hearing investors talk about what they are investing in makes a big difference. And you can find that at investorconnect.org.
Awesome. Well, Hall, this was a lot of fun. I really appreciate you sitting down and sharing your knowledge. I know I badgered you with questions all about angel investing and building a startup, and I really really appreciate it. Are there any last words that you want to leave the audience? I know you've shared a couple ways that people can connect with you outside, but anything you want to leave the audience with?
No, I think everybody should do startup investing or run a startup at some point in their life. I think you learn more about yourself through that than you will then just about any other place aside from getting married. That you should take that experience on, and you'll be the better for it. You'll learn new skills and new things that you never had before. So I think it's a great place to experience at some point in your life, if not forever. It should be a part of it. And so I encourage people to get involved.
Awesome. Well, thank you, Hall. Really appreciate you sitting down today.
Great. Well, thanks for having me. Enjoyed it.
Yeah, I did as well. Thank you. On your way out, please share the podcast with others. It's the only way that the community grows and others hear these incredible stories from entrepreneurs and top performers. And of course, pound that subscribe button so you get notified when episodes drop every Friday. I'm William Glass, CEO and co-founder of Ostrich, and of course, your host of the Silicon Alley Podcast. Have a very profitable day.
You got no time to waste, but still you hesitate. Caught in a circle saying, I'll never leave this place. Some words got you searching for the bright side over and over.